Hey everyone, today I would like to talk about a topic that is hot on everyone's mind with reminiscing of what 2008 was like, and that is about leverage, mortgages, and loan to value. How much is a good amount of loan to put on my property? Am I ever going to get underwater? Am I ever going to get foreclosed on? What if the market goes into a recession? Aren't all these loans and isn't all this debt dangerous? We're going to answer all these questions today. So, I'd like to pose the topic before we talk about debt. Let's talk about equity. Let's say that you have $100,000 to invest in real estate. Now, with that $100,000, you can buy a single family house in a nice neighborhood and have it cash flow. Let's say you purchase a $100,000 house in this hypothetical scenario and you collect revenue and rent from your tenants. At the end of the year, after you pay your property manager, you pay any maintenance and repairs, at the end of the year, you have a $10,000 profit. Now that's a pretty good investment. On that $100,000, you have made a 10% rate of return because you paid cash for the property and you did not get any financing and you still made a $10,000 profit. That would be a 10% cap rate investment. Now, the question is, should you get a mortgage on this property? Or if you got a mortgage on this hypothetical property, would you make more money? So if you have a $50,000 down payment and a $50,000 loan that generates 5% interest, you will pay $2,500 in interest throughout the year, but you will have still made $7,500 of profit even after paying your interest on your mortgage throughout the year. That is a 15% rate of return because your down payment and your equity invested on the deal is lower. And even though your profit is lower, your return, dollar for dollar, is more. I'll show you how to illustrate this. Now, if we go back to our original scenario where you have $100,000 and you instead buy two houses that each have a $50,000 payment, you still invested in two properties and still invested $100,000, but now you have two properties instead of just one. So at the end of the year, the first house that you had all cash, you made a $10,000 profit. And on the second scenario where you had two houses, you actually made a $15,000 profit because you had $100,000, 50% down on each property, so $50,000 into each property, and each one made $7,500. That means you made $15,000. That's a good chunk of change. Let's even take this to the next level. Instead of 50% down, let's do 20% down and assume that you are putting $20,000 of down payment into each property. Now, since we have $100,000 to invest, that means that we can buy 5 properties for the cost of $100,000. But each of these properties will have a loan with $80,000 as the loan amount. Now, each of these loans has a 5% interest rate. So if you have $80,000, you are going to have a $4,000 interest payment throughout the course of the year. That means that if your house would normally have made a $10,000 profit, once you pay $4,000 in interest, you are left with $6,000 of profit at the end of the year. Considering that you only had to put in $20,000 on each house as an investment to get a $6,000 profit, you actually end up with a 30% cash on cash return, or a 30% rate of return on your 20% down payment. If you have one house that has $20,000 invested in it, you made $6,000 profit instead of $10,000 compared to paying all cash for the house. So this may seem like a lower rate of return, but again, because you are able to buy 5 houses times $20,000 down payment equals $100,000, you are able to actually get $30,000 of profit because you have 5 houses, each paying you $6,000 of profit each year, even after you pay the mortgage. Now you can see over time how the profit stacks up the less money that you put down. If we were to go all the way to a 0% down payment, you would actually end up paying $5,000 in interest to have a property that makes $10,000 a year of cash. So after you pay your interest, $10,000 profit minus $5,000 loan payments end up with $5,000 total profit at the end of the year. Overall, in this hypothetical easy scenario, you can see that having a large loan amount with a lower interest rate than your rate of return or than your cash flow can be quite profitable. So because of this, I am a fan of leverage. Now, where people get into trouble is trying to forecast a future value for the property and a future cash flow that the property is not already receiving. When you do these comparisons, you need to be sure of how much cash you predict that you are going to be making in the future, and the way that you do that is by looking at comparable properties in the area and seeing how much rent they are generating and how much their expenses cost and how much profit other properties are making, and also how much you have made on other properties from your own experience and running your own properties in the past. All of this data does get funneled in, but the simple math is, as long as the interest rate on your loan is lower than the total cash that you plan to receive from the properties, and you are confident in how much you can make, leverage can be beneficial and make you more money. Now let's talk about the next section, appreciation and depreciation in the market. So let's say that you have that same $100,000 to invest in a house, and you buy one house with $100,000 in cash, no mortgage at all. Now, in general, real estate tends to go up in value. Right now, the market cycle is in a bit of a flux. Houses could be going up or down a little bit. We will see what happens in the market. But over the course of the past 10 years, real estate has gone up anywhere between 3 to 10% per year in value. I know in Texas, especially in Austin, houses went up in value 20% last year. Now, that is unusual, but for a base case scenario, let's assume that houses go up 10% per year with appreciation. Now, if you had paid $100,000 for this house, that house would be worth $100,000 at the beginning of the year. At the end of the year, the house should have gone up 10% in value, and now it's going to be worth $110,000. So in addition to the cash flow and profit that you made from the revenue of the tenant, you also had 10% appreciation income. So you made an additional $10,000 of profit because you owned a home that went up in value. Now, let's go back to our other example of putting 20% down payment, meaning that you have the same $100,000 to invest into 5 homes because you put $20,000 into 5 homes, and that is a total of $100,000. However, you got $80,000 of loan for each house. So you got $400,000 of loan to buy 5 houses, and so you own $500,000 of homes. Now, a lot of people think that this is risky because you have a lot of properties and $400,000 of loan. But let me illustrate how this can translate into profit by using leverage. Because you have $500,000 of homes for your initial $100,000 investment, if the properties go up in value by 10%, you will have actually made $50,000, because $500,000 going up 10% means that they will be worth $550,000 at the end of the year. Now, the value of these homes have gone up, but your mortgage has not. Your $400,000 loan is going to be still worth $400,000 at the end of the year, probably even less because you're making payments on that loan over the course of 30 years. So in the first scenario where you paid all cash for a nice, safe deal, you made a $10,000 profit. Whereas in this scenario where you bought $500,000 of homes, you actually made a $50,000 profit, which is a 50% rate of return compared to your $100,000 investment for that same $100,000 cash. Now again, if you were to lower this down to a 0% down payment, buy an infinite number of homes with 100% financing, when the market goes up 10%, you are going to make an infinite amount of money. However, we do have to be careful because if the market goes down 10%, you could also lose quite a bit of money. So leverage in this scenario can be good or bad, and the factors that we just have to consider is when we sell it. When you buy it is of course important, and you always want to buy deals at a discount so that you make a profit. Overall, the real estate market tends to appreciate and go up in value, so real estate is tending to be a pretty good and safe investment. However, you do have to just have the ability to know that if you sell it when the market is down, you could lose money. So make sure that the property is cash flowing and having enough profit to cover any payments along the way so that you are not forced to sell a property in a down market, and that you can sell the property once you have appreciated in value and the market is up. As long as you study the fundamentals and rents are increasing and values are increasing and the property that you purchase makes more cash flow than any expenses and mortgage payments combined, especially by a nice margin, you should be safe to not be forced to sell a property whenever the market is down, and you can ride out the storm until the property becomes positively cash flowing and the market is back up again. Lots to consider in this example, but overall, just know that real estate is a good investment because it provides cash flow along the way, appreciation over time, and when combined with leverage, it can exponentially grow the returns on your investment. That's why I invest in multifamily commercial real estate, because you can grow these gains exponentially faster than you can by paying all cash for a single family house and hoping that your one tenant and paying rent will eventually make you financially free. Follow me for more investing advice, and if you're ever interested in getting involved in commercial real estate, I'll teach you how to passively grow your net worth and income substantially more than you're doing on your own. Thanks, and tune in for more.